Welcome back to Galaxy Grid, the weekly show where we tell you everything that happened last week and what to prepare for in the week ahead. I'm Alex Thorne. I'm joined this week by Zach Bacorny, Lucas Chayan, and Will Owens from Galaxy Research. Gentlemen, welcome back. It's the new year, 2026. How are we feeling?
Feeling great. Happy New Year.
GM, Happy New Year. Yeah, it's the year of the fire horse, so big year for crypto right now.
What is the fire horse? What is that?
Based on my very quick Google search, it is a special horse year that brings dynamic, passionate, and freedom-loving energy, and it symbolizes transformation, bold moves, and cultural shifts. So all of that portends well for crypto, I would say.
Yeah, that does sound bullish for crypto.
Well, the freedom money is up. Bitcoin trading at 93.2 as we record on January 5th around 10:30 a.m. Eastern. A little bit of a bump happening, since this weekend. I was looking too, but since the capture of Venezuelan President Nicolas Maduro by the United States, uh, pretty much everything is up. Gold is up, equities are up, Bitcoin is up. Oil is mostly flat, and actually is up slightly now, almost 1%. Light oil crude futures. So I don't know. Who knows how to handle this? Lots of weird stuff happening, but let's get into the big stories this week. We're going to talk about Lighter, the perp DEX airdropping its LIT token, some interesting stuff there. We'll talk about Uniswap really finally enacting this long-awaited fee burn and what they call the unification proposal. It's actually really complicated how they enacted this across the many chains that they're on. We'll get into that. And lastly, we'll talk about some backlash, some drama. I'm not sure how to describe it in the social fi landscape. So creator coins, we'll get into that. And before we get into any of this, I need to remind you to please refer to the link to the disclaimer in the show notes. Note that none of the information in the show constitutes investment advice or an offer recommendation or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Let's kick it right off with Lighter. Will, you looked at this. This is a competitor to Hyperliquid in the highly competitive perp DEX space. This is a long-awaited airdrop. Tell us what happened and what makes their airdrop differently, and how did they execute it?
Yeah, for sure. So Lighter airdropped 25% of their supply. Pretty anticipated airdrop. There were multiple different polymarket markets trading, like when will the airdrop happen? What will FDV be 1 day after the airdrop? Lighter is kind of unique because they do this like zero fee perps. They have two tiers of fees. And so kind of what happens here is like the free tier of fees incentivizes a lot of scalp trading because people are able to trade quickly with no fees. And this does not contribute meaningfully to open interest. I feel like a lot of people need to distinguish between volume and open interest when analyzing like Hyperliquid versus Lighter. So right now, Hyperliquid OI is around 8.3 billion, Lighter is 1.4 billion. So pretty large gap right there. Like kind of reminder that a lot of OI got wiped on October 10th liquidation event. But yeah, I mean, Hyperliquid's OI, people are arguing, make the argument that it's stickier, right? And I mean, we'll see what happens. Right now, I believe LIT token is trading just below $3, but two very, very distinct designs between the two platforms for sure.
Yeah, I mean, I think it looks like Lighter OI dropped by like 25% post airdrop. So from like 2 billion to 1.4 billion, like Will said. And I was looking at like Hyperliquid, what happened post airdrop there. And it was just such a different dynamic at the time because Hyperliquid was kind of the first mover. And so Hyperliquid OI actually like increased massively after their airdrop because the airdrop was really like a huge marketing mechanism that got a lot of people who had been fading the protocol or not really paying attention to it interested in it. Whereas, Lighter, we're now seeing kind of like an established playbook and people are much more familiar with this. So OI has actually gone down. I think it's going to be really interesting. Like these perps protocols are operating, and I think like what's going to be one of the most competitive verticals in crypto, just because they already kind of have proven some product market fit. And as Will points out in kind of his newsletter article, they're not really just competing with each other and on chain. They're competing with sexes. They're competing with the Robin Hoods of the world. So they're gonna have to really distinguish themselves and I think leverage some of the advantages that comes from being a crypto protocol to continue to perform well.
It's a good point, actually. I remember almost having like FOMO after initial hype airdrop because I had no Hyperliquid exposure. And now it's like everybody's been talking about farming lighter for so long. And now that the airdrop happened, it's like, okay, what do we do now?
Well, two very different environments, not just sort of in the perp DEX maturation, ecosystem maturation phase, which is definitely true. But also, right, the Hyperliquid airdrop was what, in fall 2024 or late fall of last year, or I guess almost more than a year
Thanksgiving.
ago.
Yeah.
So it was right in that time of like peak euphoria, post-election, pre-inauguration, where everybody thought everything was going up, and indeed everything did go up during that time. So I guess the question I have is, do we look to the success of this token as any kind of barometer for the market share between Hyperliquid, Lighter, Aster, and the others that exist, or is the token going to be ancillary, you think, to their market share capture?
Yeah, I mean, well, first off, like, I think what's still to be determined, and Will, correct me if I'm wrong here, is like, what is the full utility of the lighter token going to be, and how is that going to distinguish it from Hyperliquid and the others? But second off, yeah, I think so. I mean, I think these things are increasingly going to trade off of the fundamentals of the underlying protocol and how much revenue they generate. So, if there will obviously always be some sort of speculative premium that comes from all of that plays out in all of this, but they should all trade at relatively similar multiples, depending on how the underlying protocol is performing. And I think one other tailwind for all of this that might be helpful is, Hyperliquid has been in this kind of like downtrend period for quite some time with, the broader market. But also, I think there was kind of like peak FUD going, or not FUD, but just kind of bearishness happening around the protocol due to things like, long-term people realizing long-term capital gains after the airdrop, the team unlocking, concerns about the light airdrop, and I think we've kind of moved all past all of that, and we might be entering a period where now Hyperliquid starts to regain a lot of attention. They've got some catalysts on the horizon, things like building this integrated borrow lend protocol, and I'm really curious how kind of Lighter deals with that and how that affects the various valuations.
Yeah, and regarding the token, it also kind of leads into this like broader discussion in crypto about token buybacks. Hyperliquid has been, very firm on this buyback centric token model, right? Revenue is used to buy hype, reduce supply, very transparent about it, works very well. Lighter team, I believe on Twitter mentioned that they were going to allocate revenue between both buybacks and growth depending on market conditions. So like, you know, I don't think we fully understand exactly what that means yet, but we'll see what happens there. Like teams are definitely experimenting with how to use their revenue and how to, best reward token holders.
Yeah, I mean, we're just also going through like a period of time where buybacks are brought back into question. Like Alex, we discussed this on Galaxy Brains like maybe 3 weeks or a month ago. But I think people are kind of starting to come to the realization that just using buybacks as the pure link, like connecting the token to the protocol economically, is imperfect in a number of ways. And one of those is that it actually comes at the detriment of being able to reinvest back into the protocol to stoke more growth, and improve all the KPIs that token valuations are based on. So like if you're making like $100 million a year and you're using 75 million of that to like top last your token, like that's actually incredibly negative EV. And I think that's kind of showing up in a lot of these token prices. But yeah, I think like the more nuanced and calculated approach of like we'll use the buybacks when it makes sense and it's positive EV, but like we also need to realize that we're like mostly early stage companies and need to reinvest back into the
Yeah,
protocol to stoke growth and actually keep the thing going.
was I wrong to see on X that some teams have become critical of doing buybacks? They said that you said Top Blast, that maybe spending hundreds of millions of dollars buying the top of your token and then you enter a bear market was bad capital allocation. Is there a meaningful pushback on the revenue meta or as the buyback as an expression of the revenue meta, I should say?
Oh yeah, I mean Helium like rescinded their buyback program like I think Friday or Saturday. And then that kind of stoked the Jupiter folks to also ask like the same question. But yeah, I mean, we've been talking about it on the desk for a while. Like Uniswap finally implementing the fee switch, like might have been the blow off top for the buyback dividend and era of DeFi. But no, I mean, I think like revenue has never been more important. Now we're just kind of coming to grips with like, okay, we have a bunch of protocols that actually make money. Like now what do we go and do with it? And we experimented with buybacks initially, and then people are kind of seeing how that plays out. And we're just going to continue to experiment and go to the next thing. But yeah, I guess we'll see where it goes.
Yeah, it's definitely going to be different from team to team, but I think that, probably a good strategy could be just buy back the most in certain market conditions. If the token is relatively low, you want to buy back as much as possible. And then, like, when the market's ripping, your token's at all-time highs, maybe you shouldn't be using 100% or vast majority of your revenue to buy back the token, right? Maybe you should be keeping some cash on hand for red days when everybody's flooding your token, and then you have a lot of cash to buy back the token in those market conditions. And there's no like perfect answer that we know right now, but I think that in general, teams are going to keep iterating, keep figuring out what works best, and I think it'll be really important for teams to be very transparent about everything and very clear about what they're doing exactly. But yeah, I mean, it's honestly good. I think this is good because it will only get better over time, in my opinion.
I mean, it's like pretty ironic because, right, like when most of these buybacks were implemented was like exactly when you wouldn't want to be doing them. And now that actually all these token prices have deflated so much when like it might actually make sense, everyone's turning off their programs. It's just like classic crypto, like buy the top, sell the bottom type of behavior. But I do think like ultimately what this whole buyback like idea, like it came from something we've talked about endlessly on this podcast, which is like just token design in general has been really flawed for a lot of different reasons. And like the reason that buybacks became so popular because like they were a way to show that a team was very aligned with their token. And what we're now seeing is that there's a lot of different mechanisms besides buybacks to do that. And as those mechanisms become more mature and more battle tested, I think teams will increasingly they'll use buybacks as one of their tools in their toolbox, but there's going to be a lot of other probably better ways to show that alignment and return value to token holders.
All right, well, let's pivot and talk about what might have been the buyback top, as Zach pointed out, which was the Uniswap finally enacting their fee burn. This has been years in the making, been proposed in the past and shot down, but not so now. And so interesting to turn on the fee burn late in this revenue buyback meta, but also when Uniswap is deployed across a bunch of different chains and L2s, including their own chain, the Unichain is much more complicated to enact now than it would have been, in 2021, I think, when it was last considered. First, Zach, what is the mechanism that they've done? What have they accomplished, the Uniswap governance, and tell us the story.
The buyback and burn mechanism that they put in place is just kind of one piece of like a much bigger overhaul of Uniswap. I would argue that the collapsing of the labs and the foundation into a single entity to kind of drive value directly to the protocol versus having all of these conflicting interests between the labs entity, which is maintaining the front end and skimming their own fees for themselves, and then you have the core protocol, which is like the Aave the Uniswap set of smart contracts, which are all governed by the Uni token, obviously. So the collapsing of the labs and the foundation entities into a single like unified group, I think, is really the big important takeaway here. Because that relationship has had a lot of tension, not like with Uniswap specifically per se, but just like the general structure we've seen time and time again with Aave most recently. That when you have a bunch of different parties all with diverging interests, like it can get messy. But yeah, their buyback and burn mechanism is interesting because it's not just this programmatic, like, oh, we made a bunch of money, let's just go buy the token and burn it. They actually have fees accrue in what's called a token jar, which is just a smart contract that the fees go to. And then anybody can go in and programmatically burn them on some kind of arbitrage opportunity. So they'll say like, oh, you need like $100 of Uni to claim $105 worth of fees. If you're a user who's willing to accept that 5% arbitrage, you can go in and trigger the burn, give up your Uni tokens and claim the underlying fees. So like I guess it is kind of this like endless loop of like you can burn whenever you want, but it's not as programmatic in the sense as like the protocol is not collecting the fees and then going and executing the buybacks and the burns itself. It's more market driven and open.
The fees are coming from liquidity provider fees, right? I mean, you if you provide liquidity, into a Uniswap pool, you earn fees when people interact with your liquidity, right? And so a portion of those LP fees are now being diverted into this token jar to potentially be burned. Do you think that that's going to impact the incentive structure for people to be liquidity providers on Uniswap pools? Because technically the cohort that's losing out in this new design are liquidity providers themselves.
Yeah, so as part of the proposal, labs shut down all of their front end fees. So the only place to really source the revenue from is from LPs. I mean, time will tell. Like, certainly there's a revenue hit, and they're working to put into place like some kind of auction mechanism to kind of backfill some of those lost fees. So I mean, I think this is just going to take time to play out. This isn't just going to be something like we wake up overnight and Uniswap's TVL is down 50%. Like, if it were to have a negative implication, I think this plays out over year to 18-month period, as opposed to instantly. So we'll see what happens. And yeah, we need that auction mechanism to go into place, which should bring some relief to LPs. But yeah, nonetheless, they are taking an economic hit as a result of this new structure.
Yeah, I think the biggest like criticisms I've seen so far is that potentially kind of the modeling that the Uniswap proposal has in terms of what their actual fees might be over the coming year is grossly overstated, just due to the fact that previously, or a lot of the pools that you might think are like the highest fee generating pools, are actually just kind of like wash traded, low cap meme coins that once this fee is implemented, we'll lose a lot of that volume. And also that if you wanted to claim those tokens by burning Uni, and then you went and tried to actually sell them to recoup it into USDC or something like that, you wouldn't be able to actually get the value that it looks like, because the liquidity in those pools are not really what it seems like. So I do think, yeah, I agree with Zach. Like, I don't think that short term we see like a huge hit to Uniswap like LP providers. I think we've seen like historically these guys are extremely kind of like, they're sticky. They don't really leave, and like a lot of the liquidity that there has been there for a long time. And then I also just think like the alternative solutions out there are not super compelling yet. Like the big one people point to is Aerodrome, and their token model is basically to like compensate people with a lot of emissions. But I don't think that's necessarily a better model than what Uniswap is doing, which is actually just taking some of the value and returning it directly to the token itself instead of having to rely on token emissions.
Yeah, I think it's quite interesting. Uniswap, the blue chip AMM, the first AMM, is this gonna, what about incentivization for LPs, like competition against the perp DEXs, right? Uniswap is spot, right? You are trading and interacting with actual cryptos, but the rise of the synthetic perp is an interesting alternative way to trade. Uniswap, I mean, we had this quiz that I remember joking about last year, like, what do you think is the largest pool in Uniswap? And, I wanted to say, what, like $1 billion, but it turns out it's what, about 100 million is like a ETH USDC pool. It's not that big. And in fact, I think many people wonder whether AMMs are actually good for trading, or if they're really better for launching a new coin and creating initial liquidity than anything else. Is this going to impact the competition between spot DEXs or spot AMMs versus Hyperliquid, Aster, lighter synthetics?
I feel like they're mostly two distinct things. Like, in the spot trading world, it's really the AMMs or like the passive liquidity DEXs versus the prop AMMs or like the active liquidity DEXs. Like, I don't see much overlap in terms of like Uniswap versus Hyperliquid. Like, they're kind of both in their own lane, serving their own purpose, working with a totally different user. But there is very much so like a battle between the prop AMMs and the traditional AMMs at the moment.
Yeah, I agree. I think it's I think you have CLOB, central limit order books. You've got prop AMMs, and then you've got just traditional AMMs like Uniswap as kind of the different verticals in terms of the spot trading. And I think when the perps come in is mostly as like using them as hedging instruments rather than kind of like, taking away from spot trading. Because like you can't really, like, people are using perps to like go along with leverage. It's a little bit more difficult to do that with like an AMM. You have to bring in all the lending features and everything like that.
All right, interesting. Lots to come. I think it feels like we'll be covering this a lot more, so stay tuned. Another interesting story from last week, also involving tokens, types of tokens, a big token heavy start of the year here. Creator coins, content coins, sort of if you think about, I don't want to say celebrity meme coins, but they could fit into this area. But think about Zora on
Yep.
Base, and Jesse Pollock promoting the Jesse token. Coinbase's layer 2 base has become the focus of a little bit of renewed debate after the citizen journalist Nick Shirley, who had done that documentary about the Somali daycares, launched his own coin, which people were very critical about. Lucas, you wrote about this, and what it exposes and tells us about the state of social fi in crypto. What were your findings?
Yeah, I mean, in classic fashion, I kind of criticized that the current kind of setup for these creator tokens and content coins are just, it's just not suitable, and it's not really the direction that needs to be headed in. And this is something we've seen a lot over like the past years. Like Coinbase is not, and Zora is not the first time we've seen this. You know, there was BitClout, we had Friend Tech, we've got the creator meme coins. Pumped Up Fun is making a huge push into kind of like creator capital markets, is what they're calling it. And they're all kind of following this similar arc, it seems, where like, first off, like they're not really innovating too much on the content experience itself. So like there's no real specific reason why you might want to use one of these platforms to like ingest content relative to, you know, a TikTok or an Instagram. And two, like where they do try and innovate is by introducing this token. And more often than not, the token ends up really distracting from the creator instead of helping them. And so, you know, yes, with the Nick Shirley token, right? Like he launched his token. It looks like Coinbase was involved. Brian Armstrong retweeted it. It got all this hype. It ripped up super high, and then, you know, within a few hours, it had kind of gone back to zero. And for a lot of people who are, you know, they're speculating on this stuff. It's not like they're seeing these tokens as ways to like as actual long-term content valuable things. They're just speculating on it. And so when that's the type of price action that happens, it makes them very disillusioned in why they would want to be engaged in these types of markets. And I just say, like, it's ironic that I wrote it when I did, because like as soon as we published this, obviously like a few KOLs tweeted about the Nick Shirley coin specifically, and it proceeded to rip up high again, you know. But I don't think that really invalidates the argument we're making, because I think that does address one part of it, which is, yes, maybe there needs to be better kind of like marketing and better like distribution of these tokens for people to help understand what they are and why they should buy them. But I still think like the real innovation here, which is like connecting a token with social media and content, has not been identified. That doesn't mean I don't think we're going to see it happen eventually. Like, I think the fact that you have Coinbase through Base and Zora investing very heavily in like what Jesse Pollock would say is like tokenizing everything, and then you have you know, Pump Fund, which is one of the most well-capitalized protocols in crypto, also investing very heavily in making creator capital markets a thing, means like there's a lot of fuel to keep the innovation and experimentation happening here. I just think we haven't yet cracked the code on what the success story is going to be.
Yeah, and even Jesse Pollock had his own creator coin. You know, we saw what happened with that, like 12 million plus market cap, I believe, in the first day, and now it's down 70% to like below 4 million or something. But yeah, I mean, personally, I talked to my non-crypto friends. Like, I could not see any of them seriously posting on Zora, you know, which is like maybe a problem. I don't know. I think experimentation is good. Like, it will get better over time. I remember the Pump Fund stuff very, very well. Like on the Pump Fund creator tokens, right? We had everybody was like, "Oh, Pump Fund is the new streaming meta. All the Twitch streamers are gonna move to Pump Fund. They're gonna make so much more money. You know, we're gonna have all these like normie streamers just streaming on Pump Fund all day. It's gonna be awesome." Really, it was like we had a popular Fortnite streamer hop on. He printed, you know, a few tens of thousands of dollars in creator fees and profits on his token. Interest faded, quickly switched back to legacy streaming platform. You know, it's like the hype is, it always sounds way better in your head than what actually happens. But yeah, I don't know. We'll see. And then you also wrote about FOMO a little bit, which was kind of cool too.
Well, hold it on FOMO for 1 second, but you know, here it is. It's a very you know, common chart pattern you see in meme coins. I I guess the question I have, like, one of the things that they said, apparently Nick Shirley had been deplatformed by YouTube or demonetized. And I saw that Jesse Pollock was pointing out or hyping the fact that he had made X amount of money with this token, whereas, on YouTube he'd been demonetized. And I guess the question I have, and I think, Lucas, is what you're getting at here, is like, when they say that you can monetize as a creator in this way, don't they really mean just dump your token on your audience, right? That's the only current way that we've seen this be designed yet, right? Surely there's meant to be like some kind of ongoing subscription, or some way that like owning the token gives you better content or better access to content, not simply that you create effectively a meme coin about the fact that you have content and then sell it.
With the Pump Fund creator tokens, though, the streamers/creators actually can profit without selling any tokens, just because they get rewarded creator fees based on the trading fees of the token.
Oh, so like Pump Fund is sharing some of the trading fees that it earns with the creator.
Exactly.
That's been like one of the areas where we've seen them innovate. But like, again, right? Like, it's a very difficult business model, because that means that you have to ensure that like your token is generating sustainable volume to like ensure that that's providing a sustainable source of income, right? Like on YouTube or on Twitter, like you are getting kind of a monthly payout. And once you reach a certain spectrum, that provides some sort of consistent payout that you can depend on. I think for these type of creator coins, if you're depending on the amount of trading volume that's happening on your token on a week-to-week basis, that's going to vary quite a bit. The counter argument there is like that just incentivizes you to be the most viral human being alive constantly, so that everyone is constantly trading your token. You're getting creator fees from it.
And I think just like the broad issue with these things is like when you like tokenize content, is like you're turning into a market and somebody has to lose in a market. So like when your viewership is just constantly like, oh, I want to watch this person's content or whatever and get involved, but like it may require me to lose money. Like I don't know. I think that's like the big issue. Like somebody has to lose in this whole thing, which like may or may not be good. But I think it certainly detracts from the experience that people have with it, because like like you essentially have to lose money at some point to be.
It's just a big step away from the idea that like Friendtech was trying to do, or even Farcaster or other, where the way that crypto and blockchains interact with social media was about resiliency, owning your data, being able to pay and receive tips in microtransactions, right? That seemed like a much more egalitarian, even possibly altruistic way for these technologies to interact, rather than, well, let's just create a token that's called my name and let it trade, and maybe figure out ways that I can earn revenue from its trading that doesn't involve me dumping my share of the tokens. But it seems like an admission that social fi as a genre of crypto is kind of a failure so far. An admission, one that I would say is kind of obvious, but I mean, this seems like it's been given up on. Even Farcaster, right there, they're closing shop, right?
Yeah, I agree. I think to date, yes, it's definitely like this is another great example that SocialFi has kind of failed as like like it's not perp DEXs, right? It's not found product market fit to the point where everyone's like on board and trying to launch this. But I do think like we're in a world where like we're trying to like financialize everything. So it does make sense to me that like social media has a huge addressable market to do that. But the one thing I haven't really thought about, and I totally agree, Alex, is like we probably need to get back to this idea of like there's a lot of value in these platforms being like uncensorable and permissionless versus the others. Like you really don't hear any discussion about that anymore. It is purely focused on the financial aspect. And that's a great example of like where you're actually advocating for a platform that has like inherent advantages over the incumbents, rather than just saying you can buy a token and it'll go up.
Yeah, I mean, this is what the Bitcoiners are doing with Noster, which has no token or incentivization, but is decentralized social media, notes and other stuff on relays, transferred over relays, I think is what it stands for. and people are paying. They're tipping. They're just tipping each other with sats over Lightning, and they're doing it a decent amount. It's an interesting area. I think I agree with you, Lucas. Like it's such a big area, social media, and so much content is social these days. I mean, I think if you look at, you don't even have to look at the top content creators, YouTubers, TikTokers, whatever. They're all doing better numbers than CNN. Like that's a fact, right? So figure out a way to bring value to the audience or to bring value to the creator and share value with the audience. I feel like it has to be an area where humanity is going to figure something out here that's durable and sustainable eventually.
Yeah, and I think the one thing to consider here too is like Elon Musk acquiring X and opening it up and kind of maybe eroding the censorship resistant benefit of like a blockchain based social media app. And then also just breaking the network effects of social networks is incredibly difficult. Like even when Twitter had all of its problems in the past and like people tried kind of going against the grain of it, like it still couldn't be cracked. And like every single day that Twitter is up and running and not censoring people and doing the wrong thing, like the network effect only gets stronger. So I think as time goes on, it's just going to be harder and harder to kind of break into this category and essentially spin up a new social network from zero to defeating Twitter. Like I think that's going to be extremely difficult.
Yeah, I just want like one final point I'll say is like I think like a great example of like how these so far like experiments with SocialFi have like failed to materialize in any like successful way is like Gary Tan, the founder of Y Combinator. Like I just found this out when I was like researching for this newsletter piece. He has a creator coin. Like you're talking about one of the most successful like investors in the history of the world that everyone wants to have access to, right? And like 99% of the people don't even know that they can get access to him by owning part of his creator coin or that he's even experimenting in this space. So like, I think there is a lot of interest from like very smart people that see potential here. We just haven't cracked the code yet.
All right. Before we wrap, what is everyone following for the week ahead? It's the first true week back here, working this week and in markets. What are people looking at?
Yeah, I mean, I'm not like looking at anything specifically, but like a big theme that I'm going to start following this year, and I like have been following for a while, is impact markets and decision markets, like kind of feeding off of the marketization, financialization of everything. It's kind of an evolution of prediction markets, and I've been seeing a bunch of people talking about it more on the timeline. So gonna work to put out a report on that to kind of bring everybody up to speed on what it is, because there's not actually many good resources out there on the topic.
Yeah, I'm looking at a few things. I think that, I mean, you always see like people tweeting like the 3 Ps of 2026, right? You got prediction markets, privacy, and perps. So everything in that space, there's a lot of mindshare there. I'm honestly really hoping Pump Fund does something. The founder has not tweeted in 2 months. He's been completely silent. Like it's kind of crazy. Remember, like they still promised an airdrop to meme coin traders. Everybody's kind of waiting for that. And then last kind of thing on the buybacks, they have repurchased over 17% of their token pump. So this is like, I think over $230 million in buybacks, and the token is still below ICO price. So that's just like a clear example of, maybe, I don't know, maybe this isn't the best strategy, but yeah, definitely hoping they do something.
The 3 Ps, I like that. I hadn't heard that. I've got a piece on X402 coming out this week. Taking a little bit of a different angle, looking at kind of how it might integrate with the more with kind of the incumbents off-chain e-commerce companies that are building agents and agentic payment services. And then I'm we do a quarterly update on Solana, so now shifting my attention to kind of what happened in Q4 and the wrap up of 2025.
Nice. And I am following developments in Washington. As we said a couple weeks ago, the Senate Banking Committee has delayed any hope of marking up the crypto market structure bill until early January. Here we are, January 5th or 6th. And so we're expecting some movement in the U.S. Senate in the first half of this month. I guess the big question is whether or not Democrats are going to get involved here, whether a negotiation can be successful that makes both Democrats and Republicans put forth something. If not, I think it's very possible you'll see the Republicans advance their own bill and sort of roll the dice on what happens, challenge Democrats to vote against it. We'll see. There's also an interesting proposal out of the House on a crypto tax proposal. I think has a lot of problems, needs to be altered, but nonetheless, I think we could see some interesting movement on crypto tax, things like de minimis exemption, staking, the handling of staking and mining rewards, and wash trading apparently as well. So this is it. This is sort of for crypto policy before the midterms. This is prime time. Between now and June-ish is probably our only chance for the near-term future to get another big bill out of Washington on crypto. That's it for this week's episode of Galaxy Grid. Thank you to Lucas, Zach, and Will. We will see you all next Tuesday. Have a great week.